Hey guys, what is up? Welcome back to the channel. Whenever there's a rise in stock prices and this rise tends to get ahead of itself, as participants in the stock market, we tend to ask whether are we in a stock market bubble. And to answer that question, we need to know what does a bubble mean in the stock market. And that is what we'll be going through in this video. What is a stock market bubble? A stock market bubble is defined as the rapid escalation of stock prices followed by a subsequent fall in stock prices. And during a stock market bubble, the fundamentals typically do not keep up with the rise in prices. Or in some cases, there might even be divergence between stock prices and their fundamentals. This price chart illustrates how a typical stock market bubble looks like. On the left side of the chart, you'll see that prices were hovering around the price range of $40 to $50. And after that, there was a rapid rise in stock prices. In fact, stock prices rose almost parabolically during this period. You can also bring up the number of likes in this video by liking this video because it will really help the channel grow and allow me to produce more content such as this. Okay, let's get back to the video. So over at this point over here, prices rose from around $50 to almost $120 in a span of just a couple of months. And just as quick as prices rose, prices also declined. Prices declined from its high of around $120 all the way to $36. The popping of this bubble wiped out almost 75% of its value. While the process of forming a bubble might seem fast, with the rapid escalation of stock prices, followed by an equally quick decline, stock market bubbles go through different stages and they all follow this template. And this template that stock market bubbles follow are these 5 stages. I've adapted these 5 stages of a bubble from the economist Minsky. A stock market bubble will go through these 5 stages. The first being displacement, second is the boom phase, the third is euphoria, followed by a bubble popping trigger, and finally panic. Now, let's take a look at these individual stages. A stock market bubble starts with the displacement stage. In this displacement stage, investors become enamored with something new. This can be a new company, new product, new technology, or new trend. What all of them have in common is this: opportunities to profit that didn't exist before. The next phase is the boom stage. During this stage, the early adopters start to participate in these profit opportunities. Because these opportunities are still relatively new, not many people have heard of it yet. So even though there is a steady stream of early adopters, prices rise gradually at first, but slowly gains momentum as the new opportunity gets more and more coverage and attention. And before long, word gets out and the cat is out of the bag. This is where the mainstream comes in, leading us to the third phase. The third stage is known as the period of euphoria. During this stage, caution is thrown to the wind and prices skyrocket. More and more people take part in these opportunities and more people start to profit. And as a result, it seems like everyone you know are making profits from this opportunity. People you might think who are not as bright as you are also making money. While every Tom, Dick and Harry is making money, by sitting on the sidelines, you might look like a fool for not taking part in this easy money. And this creates a strong feeling of the fear of missing out. And this fear of missing out draws even more participants into this opportunity, which continues to drive prices up. And as prices continue to rise, this pulls in even more people who have the fear of missing out, creating this cycle. And at this stage, valuations reach extreme levels. While participants in the opportunity are still basking in their glory, this sets the stage for the next phase. The next phase is the bubble popping trigger stage. As more and more people jump onto the bandwagon, this drives up both the demand and price of the stock. And as prices rise up in an unsustainable way, its rate of return will eventually start to decline. The opportunities to profit become more and more scarce, and these opportunities are no longer as appealing to the latecomers as compared to initially when the early adopters first came in. And in some extreme cases, a fatal flaw might be discovered in the opportunity. The point to take note for this bubble popping trigger stage is that it doesn't necessarily have to be a single event. It can be a series of events, but all it takes is only a small trigger to pop this bubble. The popping of the bubble brings market participants back into reality. And when the bubble pops, the participants who are lucky enough to have some profits will look to cash in their profits. And the participants who are not so lucky will look to cut their losses. There will be a rush to the exits, setting the ground for the fifth and final stage, the panic phase. During this panic phase, there will be massive sell-off and market prices will start to decline as rapidly as they have ascended. These are the 5 stages that a stock market bubble will go through. Now we will take a look at examples back in history of bubbles and how they follow this template. The first bubble example that we will take a look at is the tulip mania. The tulip mania took place back during the 17th century in Netherlands. At that time, the Dutch was the leading economic and financial power and they had one of the world's highest per capita income. What made the tulip so special at that time was that the tulip was different from other flowers in Europe because of its intense petal color. Furthermore, it took a tulip 7 to 12 years to form a flowering bulb. The rich in Netherlands at that time started to collect these tulips, and before long it became a coveted luxury item. However, during the initial period, people bought the tulips to flaunt their wealth and reflect their status in society, but not as an item to speculate on. However, as prices of tulips start to rise, tulips became more of an item of speculation rather than an item of collection. And this speculation caused prices of tulips to skyrocket. During the height of the speculation, 40 tulip bulbs could fetch prices as high as 10 years worth of salary of a skilled labourer. And to put that into context, at that time, the salary of a skilled labourer is one of the highest in society. So just imagine 40 tulip bulbs for 10 years worth of a skilled labourer's salary. That is just insane. Another extreme example was that a single tulip bulb could be exchanged for 12 acres of land. 12 acres of land is approximately equal to 12 football fields. So a single tulip bulb at that time could fetch you land area equivalent to the size of 12 football fields. But in 1637, during a routine tulip bulb auction, there were no buyers, and this greater fool scheme could not continue. The greater fool scheme is this: it's alright if you are a fool buying at high prices as long as you can sell it at a higher price to a greater fool. But you don't want to be the fool that buys at the highest price and has no one to sell to, because then you'll be the greatest fool. So the greater fool scheme could not continue unless someone else was willing to pay higher prices than the price it was purchased at. After that, tulip prices came crashing down. Let's take a look at the development of the tulip mania bubble using the 5-stage template. The first stage is the displacement stage. At this stage, tulips were just starting to get introduced to the Dutch. And because of its relative scarcity and the rich taking an interest in it, this caused tulip prices to start to increase, laying the foundation for the boom stage. As more and more people took interest in tulips, this drove the prices of tulips up. From being an item of collection, tulips became an item of speculation, which led to the euphoria stage. At this stage, people who bought tulips were buying purely just for speculation. Since the prices of tulips only seem to go up, more and more people start to speculate on tulips, causing tulip prices to reach astronomical levels. But all of this came to a grinding halt in 1637. During a routine tulip bulb auction, buyers failed to turn up, and this created the bubble popping trigger. People started to sell their tulips to protect whatever profits they made, and for some to cut their losses. All of this created a massive sell-off, which leads us to the fifth and final stage, the panic stage. So through this tulip bubble example, you can see how the tulip bubble followed this 5-stage template. The next example that we'll be taking a look at is the US housing bubble in 2006 and 2007. While there are many factors which caused the US housing bubble, I believe that these are the two main causes for the US housing bubble. The first is low interest rates and the second is lax regulation. After the back-to-back crisis of the dot-com bubble and the September 11 attacks, the Fed lowered and kept interest rates low for a sustained period of time. And on top of that, there were lax regulations. Lenders were far too willing to issue risky loans. And one such example was the ninja loans. So basically, ninja loans were offered to people with no income, no jobs, and no assets. And this showed how lax regulation were at that time. The combination of low interest rates and lax regulation led housing prices to increase unsustainably during that period. And as we know, when the US housing bubble popped, things became ugly very fast. Let's see how the US housing bubble followed the 5-stage template. The first stage is the displacement stage. The combination of low interest rates and lax regulation created opportunities to profit in housing. The early adopters came in and set the stage for stage 2, which is the boom stage. Only a few early adopters were using these opportunities to profit. The rest were just people who were really looking for housing and not for investment or speculation purposes. However, as word got out, more and more investors and speculators start to come in. And this leads us to the next stage, the euphoria stage. At this stage, investors and speculators were buying houses just for the purpose of flipping them and making a quick buck. And things got so bad that even people with no income, no job, and no asset could take up loans to buy housing during this period. And all of this created an unsustainable rise in housing prices. But before long, because regulation was so lax, it was no surprise that there were more and more mortgage defaults, which created the 4th stage, the bubble popping trigger. At this stage, people were borrowing based on their housing equity value, and that their housing equity value will rise over a period of time. However, when housing prices start to decline, people start to default on their loans and their houses were put up on sale. This influx in the supply of housing created a downward pressure on housing prices, which leads us to the 5th and final stage, the panic stage. At this stage, many houses were put up on sale, creating an even greater supply of housing. And because supply was greater than demand, this causes housing prices to fall even more. So the US housing bubble also follows this 5-stage template. To recap, the 5 stages of a bubble are the displacement stage, followed by a boom stage, followed by euphoria, and then a bubble popping trigger, and finally the panic stage. Using this 5-stage template, you'll be better able to identify stock market bubbles in the future. And in addition to this template, I will also look out for signs of a bubble. This is not an exhaustive list. but are just some of the signs of a bubble that I look out for. So the first sign is extreme valuations. As we have seen for the tulip and housing bubbles, in both instances, prices reach an extreme valuation. So that is the first sign of a bubble. The second sign of a bubble that I look out for is reading this sentence and see whether it's applicable to the market right now. So the sentence is carrying on an undertaking of great advantage but nobody to know what it is. If you were to ask the Dutch back during the tulip mania, why is the price of tulip so high? You probably cannot get a logical reason behind it. So one sign of a stock market bubble is when the price of a stock increases, but no one really knows why the price of a stock is increasing. In other words, there's a mismatch between the price of the stock and its fundamentals. The third sign of a bubble is when every person on the street is taking part and talking about how easy it is to make money in this opportunity. For both the tulip bubble and housing bubble, we see how everyday people on the street are able to make easy money during that period of time. So these are some of the signs that I look out for in a stock market bubble. If you are new to this channel and have not subscribed, make sure you subscribe to this channel so that you don't miss out on future videos such as this. I'll see you in those other videos. To your financial success.